Have you ever stared at a stock chart and it just looks like a bunch of random squiggles? Well, what if I told you those lines are actually telling a story? Today, we're going to learn the visual language of the market and figure out how to read its next move before it happens.
I mean, this is the million-dollar question, right? It's the thing that keeps traders up at night. You're riding a hot streak, everything is going great, but there's that little voice in your head asking, is this the top? Is this the bottom? We're about to look at the signals the market sends right before it's about to make a big U-turn. And that's where these things called reversal patterns come into play. You should think of them like a signal flare that gets shot up from the market battlefield. It's a really clear visual cue that whoever's been in charge, whether it's the buyers or the sellers, is starting to lose their grip, and the whole tide is about to turn. So where do we even begin? Well, we've got to start with the absolute classics. If we're learning the language of charts, these patterns are pretty much the ABCs. They are some of the most basic and most common signals you're ever going to see. The M and W formations. You probably know them as the double top and the double bottom. What's so cool about these is the perfect symmetry. On one hand, you've got the bearish M-shaped double top, which tells you an uptrend might be over. And on the other, you have the bullish W-shaped double bottom, which signals the end of a downtrend. They're literally mirror images of each other, and each one tells a dramatic story about a battle for control of the market. Okay, let's walk through the story of a double top together. So step 1, a strong uptrend slams into a resistance point. Boom, that's our first peak. Step 2, the price pulls back a bit to a level of support. Now this support line is absolutely crucial. We call it the neckline. Step 3, the buyers try to push higher again, but they just run out of gas at the same ceiling as before. This second failure right there, that's the big warning sign. And finally, step 4, the price drops again, and this time it smashes right through the neckline. That breakout is your confirmation. The sellers are officially in charge now. And this is what it's all about. That M shape isn't just a pattern, it's a story of buyer exhaustion. Think about it. Buyers had 2 chances to push to a new high, and they failed both times. That is a massive sign that they're just tired. The bull run is out of fuel, and the bears are ready to take over. Now, let's just flip the script for the double bottom. It's the exact same story, but with the roles completely reversed. This time, sellers are trying to drive the price into the ground. They try once, they fail. They try again, they fail again. That W shape shows their power is fading. The breakout above the neckline tells you the buyers are storming back in. Oh, and here's a key tip. Don't get hung up on perfection. The 2 bottoms are almost never at the exact same price. A little wiggle room like 3 to 4% is totally normal. So if 2 failed attempts are a big deal, what happens on the third try? Well, that brings us to triple tops and bottoms. You can think of these as the supercharged, more powerful versions of the double patterns. A third failed attempt to break through a key level shows that the support or resistance is like a fortress, and the reversal that usually follows, it's often way more powerful. Okay, let's get into what is arguably one of the most reliable and most famous reversal patterns in all of technical analysis. And no, it's not a shampoo. It's the Head and Shoulders pattern, and it tells a very, very specific story about a market reaching its peak. Let's trace the story this pattern tells, okay? First, you get the left shoulder. That's a strong peak and a healthy uptrend. Then comes the head. This is one final all-out push to an even higher peak. But after this, the buyers are just exhausted. They try for another rally, but they can only manage a lower peak, and that's the right shoulder. The line connecting the low points between these peaks is our neckline. A break below that line, that's pretty much the final nail in the coffin for the uptrend. And you guessed it, just like we saw with the double top and bottom, this pattern has a perfect mirror image. The inverse Head and Shoulders shows up at the end of a downtrend. It tells the exact same story of fading momentum, but this time it's the sellers who are running out of steam. It's a really powerful signal that the bears are going into hibernation and the bulls are finally waking up. All right, let's look at some patterns that are less about obvious peaks and valleys and more about the market's energy, either compressing or expanding. These are wedges and triangles, and they signal a big shift in volatility that very often comes right before a major breakout. I want you to imagine the price getting squeezed between 2 trend lines that are getting closer and closer together, almost like a spring that's being coiled tighter and tighter. In a rising wedge, the price keeps getting pushed higher, but with less and less power each time. That's a bearish warning. In a falling wedge, the selling pressure is getting weaker and weaker, which is actually a bullish sign.
In both cases, that coiled up energy is building toward a huge release, usually in the opposite direction.
But what if the market does the exact opposite? What if volatility is expanding instead of shrinking? Well, that gives us the expanding triangle, and it looks just like a megaphone. The price swings get wider and wilder, making higher highs and lower lows. This pattern is basically the market screaming that it's completely undecided, and that kind of uncertainty often leads to a really sharp reversal. So, which way is it going to break? That's the all-important question. If this megaphone pattern shows up in an uptrend and the price breaks below the lower trend line, that's a bearish signal. If it shows up in a downtrend and breaks above the upper trend line, that's a bullish signal. As always, you've got to wait for the breakout. That is your confirmation.
So you can see the patterns now, which is great, but how do you actually use them without getting burned? Just knowing what they look like isn't enough. You need a game plan. So let's build a simple toolkit with a few rules you just can't break. Spotting the pattern is only half the battle. Seriously, executing the trade the right way is what really counts, and it all boils down to just three critical rules. Think of this as your pre-trade checklist. First, and this one is absolutely non-negotiable, wait for confirmation. A pattern means nothing until the price actually breaks that key level. Second, look for other signs that agree with you. Use other tools to back up your theory. Is there a big spike in volume on the breakout? Do your other indicators like MACD or RSI tell the same story? The more evidence you have, the better. And third, practice. There is no substitute for screen time. The more charts you look at, the more this stuff just becomes second nature. And this quote from the material we're looking at really just says it all. The whole game is of practice. I mean, anyone can look at a chart from last week and spot these patterns. It's easy in hindsight, but spotting them in real time and having the guts to actually act on them, that only comes from experience. So there you have it. You now have the toolkit to start identifying these major turning points in the market. You've got the technical know-how, but the final question isn't about what you can see on the chart anymore. It's about whether you'll have the discipline and the confidence to trust what you see and act on it. And honestly, that's the real challenge.